Could a few smart moves before December 31st help you keep thousands more in your pocket? Welcome to the Lawyer Millionaire, where we deliver financial planning and business planning insights for ambitious law firm owners so you can enjoy more time, more abundance, and less stress, even if you're still growing your law practice. As the year draws to a close, and it's coming fast, tax season is just around the corner. Are you ready to maximize every possible deduction and reduce your tax burden? End of year tax planning can be a game changer, but many law firm owners miss out on strategies that could significantly impact their bottom line. So today, we're going to break down some end of year things that you can think about and some effective tax moves that you can make right now. Okay, let's start with some tax saving opportunities that you might want to take advantage of before the year wraps up. As a financial planner, the biggest one that comes to mind is retirement contributions. And you may already be familiar with retirement contributions, but these are one of the most effective ways to reduce your taxable income. With your retirement plans, you have a little bit extra time beyond the end of the year for your traditional IRAs and Roth IRAs, even your SEP IRAs and solo 401ks. You have until the tax deadline. And that can get pushed back even further. For most folks, that's, April 15th. But if you file for an extension, that can get pushed all the way back until October. So if you're a solo practitioner, you have a small firm, you might be eligible for a SEP IRA or solo 401k. Those tend to be very, very popular. As you get larger, you're looking at maybe a 401k, traditional 401k, or even a defined benefit plan. And all these different plans offer substantial tax advantages. The SEP IRA is often the go-to among tax advisors. It allows you to contribute up to 25% of your income, your W-2 income, up to a maximum of $66,000 for 2024. So that reduces your taxable income by that amount and basically defers that income into the future when you go to take that money in retirement. The solo 401k actually is my personal favorite. I like it a lot better because it gives you the ability to contribute more than the SEP IRA because it doesn't have that pesky 25% on all of it. It's a little complicated in the breakdown, but there's a chunk that you can contribute whether, up to 100% of your income is the employee portion, and then there's an employer portion. So we'll jump into that on an upcoming episode and dive into more of the specifics of the solo 401k, but that is definitely one of my favorites. Now, the IRA, traditional IRA, you can put up to $8,000 if you're over $57,000 for everybody else, and that allows you to defer that money into the future, right? So that amount that you contribute is not taxable in the current tax year. But like I said, you've got some extra time on that. But that is one of the go-to ways, top of the list for reducing your taxable income. Now, on the other hand, you may be thinking about actually increasing your taxable income. So this is where end-of-year tax planning becomes really, really important because as a law firm owner, your income fluctuates up and down. And as you come into the end of the year, the biggest question you want to ask yourself and you want to figure out is, how has the year been for us in terms of profit? Has this been a great year? Are we up in terms of income? Are we ahead of the game? Is this an abnormally high year? Is this an average year? Or is this a below average year? Is this a year where our income is lower than expected? And if your income is lower than expected, rejoice or your profit, because this opens up an opportunity for you in the possibility of doing a Roth conversion. So let's talk about Roth conversions. As a financial planner, this is one of the biggest things I think about as we come into the end of the year. The Roth conversion allows you to take money from your traditional pre-tax retirement accounts and convert it over to your Roth IRA. So there are no limitations or no minimums, maximums, or no income eligibility requirements. You can do as little or as much as you like. Basically, you take a certain amount, whatever amount you take from your traditional IRA, you're going to pay the taxes on now, and then you're going to convert that over to your Roth IRA. That's the cost. The cost is paying the tax, income tax. So let's say you convert $10,000. You're going to move $10,000 from your traditional IRA over to your Roth IRA. You're going to pay tax on that $10,000 today. But being in the Roth IRA, it's going to grow tax-free, and then withdrawals in retirement are tax-free. So you're basically shifting income into the present year. If it's a low tax year, a low income year, a low tax bracket, that might be a great, smart thing to do. We also want to think about some other things as we come into the end of the year. Charitable contributions comes to mind, right? If this has been an abnormally high year in terms of your income, you may be thinking about giving to charity. Donations to qualified charities are tax deductible. And if you want to make a significant gift, but aren't sure where, like let's say you want to give to charity, but you're like, I don't know where to give it or who to give it to. Here's a great idea. You can set up a donor advised fund. With a donor advised fund, you get the tax deduction in the current year. So you could give $1 million to charity, right? Put $1 million in your donor advised fund. I'm going to get $1 million deduction this year, or however much you qualify for, right? Okay, but then the money's there in the donor advised fund, and then I can choose when I actually give it, when I actually distribute it from the donor advised fund to charities of my choice. And it can be now, it can be down the road. So this is a way of kind of bunching those contributions together. If you give to charity, what you might want to do is consider a donor advised fund so that you can bunch your deductions into those high income years and maximize the impact of those charitable deductions. Also, if you're at retirement age, you're taking your RMDs, you can also qualify for making a qualified charitable distribution directly from your IRA. This allows you to meet your RMD requirement without having it count as taxable income. The only way to do this is to get, to actually have, without actually qualifying for the charitable deduction, you got to do it directly from the IRA as a qualified charitable distribution, right? And that allows you to count that RMD, to basically not have that RMD count as income for you at all. And you don't have to worry about whether or not you are itemizing or can qualify or how much, of a deduction can I get. That allows it to basically skip right over you. So that's a great thing to think about if you are, if you're retirement age and you're coming into the end of the year, and you've got to take your RMD, think about a qualified charitable distribution. Again, it doesn't work if you take your RMD and then give it to charity. I mean, that can work, but you got to worry about, itemizing and how much you actually can give to charity and get as a tax benefit. If you do it as a qualified charitable distribution, it goes directly from your IRA. Automatically, it's not going to count as income, but you got to make sure that you communicate that with your accountant and that they're familiar with that strategy. So something to think about as well. Now, maybe you're, not quite there. RMD age is 73 now for those who have not reached it. So it might be a while before you get there. The biggest thing as a law firm owner for you to think about are ways that you can either defer your income or accelerate your expenses. So, it's a high income year. Maybe what we want to do is push income into next year. How would you do that? Well, basically, you might delay collecting income, right? Delay sending out invoices until January, or ask certain clients to hold off on payments until after December. This way, you're pushing income into next year, lowering your current tax liability. Just make sure that this approach fits with your cash flow needs. Now, on the other end, you could also accelerate expenses. So you can push expenses into this year. Maybe you have things you're going to pay for in January. Why don't we prepay them in December so we can move that deduction into the current tax year? Think like office rent. Maybe you could pay that early. Equipment, supplies. Maybe there are subscriptions that you pay for. Maybe you could pay those up front. Maybe sometimes they give you a discount for doing that. So that's going to allow you to basically play around with the end of the year, deferring income, even maybe accelerating income. Let's say it's a low income year, right? Then you want to maybe accelerate income into this year, take advantage of the low tax rate, encourage clients to pay up front in December, prepay for next year, or even deferring expenses into next year as well. There are some deductions that you want to really pay attention to closely as we come into the end of the year. Your home office deduction is one that is one of the most frequently overlooked, but it can provide substantial savings. To qualify, you need to use a portion of your home exclusively for business. If you have a home office, you might be able to deduct a percentage of your rent or mortgage, utilities, even your internet or phone, if you have a landline, expenses based on the size of your office as it relates to the size of your house. Even if you're working from home only part-time, you might still be able to qualify for this, even if you have a real office somewhere else. Just make sure that you're following IRS guidelines and work with a tax advisor to help you with that. Business expenses in general. Here's another one, number 2. Just all the business expenses. As I have worked with many law firm owners over the years, one of the things that we find is that there are some business expenses that are winding up on the personal cards. So you want to make sure, this is, good cash flow planning, number 1. Put all the business expenses on the business cards. That way, you don't have a hot mess to deal with when it comes tax time. You're looking through all of your accounts trying to find all the business expenses. And that's very difficult. And the problem is you end up missing some, and then you're not getting some of the deductions that you could get. So make sure that all those little things that you're paying for those on your business cards. Software subscriptions, office supplies, marketing costs, meals with clients. Make sure that you are deducting all of those to the fullest extent that you can. Another thing to think about potentially are your health insurance premiums. For self-employed law firm owners, your health insurance premiums can also be a tax-saving opportunity. So that's another one to talk about with your tax planner as well. Let's talk about avoiding some pitfalls as well. It's important to make sure that you're watching out for a few things. The biggest thing a lot of law firm owners struggle with are their estimated tax payments. Make sure you're up to date on those estimated tax payments. As we come into the end of the year, your next one is going to be in January. The IRS requires individuals who are self-employed or owners of businesses as well, who are not having their taxes withheld, to make quarterly tax payments. And missing those payments can result in penalties. It used to not be so bad, but as interest rates have gone up, so have the penalties. The IRS has raised the interest costs that are charged to missing those payments. You also have to be careful about the timing of those payments. So if you have a lot of income in the beginning of the year, but you don't make your payments until the end of the year, then the IRS is going to penalize you based on the timing. So even if you pay all that you should pay, if you haven't paid enough each quarter, right, then you can get penalized. So be extra careful about those estimated tax payments. Depreciation is another thing to think about. And, we still have a couple of years left on the current tax law, and the current tax law is set to expire at the end of 2025, but it could be getting extended here as Republicans have come back into control of Congress. One of the things they've talked about is extending the current tax law. A big part of that is bonus depreciation. Basically, when you buy equipment for your office, you have to depreciate that over time. You don't get the full tax benefit up front. But bonus depreciation allows you to get depreciate it faster, basically. So you get more of the tax benefit earlier. So, let's say, you have a piece of equipment and the depreciation timeline is 10 years. You buy it, you're going to write off or deduct a tenth of it each year. That's straight line depreciation. But the current tax law has provisions for accelerated depreciation, so you can deduct more of it up front, essentially. So how does this affect you? Well, maybe you're thinking about buying a new car for the business. By the way, if you're a business owner, is your vehicle owned through the business or leased through the business? That's a great idea. You can make an argument for using it as a business vehicle if you do a lot of traveling, meeting with clients, going to conferences and events and things like that. So that could very much be a business asset. And then you can depreciate that. If you own it through your business, you can depreciate it over time and get some of that tax benefit over time. So maybe you had a really killer year. Maybe you want to buy a new car, right? And then accelerate a little bit of that depreciation up front, and get some tax benefit there. Employee benefits and bonuses, think about that as well. If you're giving out bonuses this year, maybe if you had a really great year, give those out before the end of the year, before December 31st, and get that tax benefit this year. Or maybe it wasn't such a great year. Maybe you're going to defer those into January. So your employee bonuses and benefits can be something you can use as a tax planning area or opportunity as well for you. Okay, so we went through a bunch of different ideas. The biggest thing as I look back through here is the charitable contributions, especially thinking about those RMDs. If you are of RMD age and you're taking required minimum distributions from your pre-tax accounts, the ability to make a qualified charitable distribution directly to a charity. And by the way, that could go directly to your donor advised fund, because the donor advised fund is under a 501c3. And so you could do that as well. And then the Roth conversion. I think that is just like cream of the crop. That's the top thing everyone needs to be thinking about as you come into the end of the year. And because you have, through the Roth conversion and through all of these different things, essentially, you have the ability to control the timing of your income. And it makes a huge difference. Because if you had a killer year and your tax rate is 35% this year, but normally it's 22%, pushing some money in income into next year can save you that difference, right? 35 minus 22%, right? What is that? 10, 13%. So that's 13% in taxes you might not have to pay on your marginal rate if you're able to shift income into a lower tax year. So really, really critical things to think about. You don't think about, it doesn't really seem like it can make that big of a difference when you first start talking about it. When you actually break it down, that can make a huge impact on your bottom line. So the takeaway here, don't let tax season sneak up on you. Taking just a few proactive steps now can make a huge difference in your final tax bill and your overall financial well-being. Set aside some time to tackle your tax planning. It's a smart investment in your future. A little bit of context here, smart tax planning is just one piece of the puzzle when it comes to creating long-term wealth. And it's a big part of what we do here at the Lawyer Millionaire. We provide year-round tax planning, proactive tax planning to our clients. Because your taxes represent your largest expense in most cases. So if you can reduce some of that expense, you can really save a lot of money. Every dollar you save on taxes is then money you can reinvest in your business, in your retirement, or in experiences that bring you joy. And this is what we do, helping law firm owners like you keep more of what you've earned and build a financial future that aligns with your goals. So if you need help with this, please reach out, schedule a call with us. I'll put the link to schedule a call with me in the show notes. I'd be happy to chat with you about how you can save more on taxes, both in the current year, both now and long term, by creating an optimized tax strategy. This has been the Lawyer Millionaire Podcast. I'm your host, Darren Wurz. Thank you so much for joining me on this journey to expand your business, maximize your profits, and secure your financial future. I can't wait to connect with you again next time. Until then, take care and keep pushing forward.